Okay, so welcome everyone to another Breakfast with Birkbeck webinar. Some of you will know that this series has been running since October, actually, but this week it is one of many events happening across Birkbeck as part of the Birkbeck Climate Festival. So if you haven't checked that out, then I'll pop a link in the chat to where you can sign up for events and see what is going on as part of that. But today for our webinar, our topic is Financing a Greener World. How do we manage environmental risks in investment and insurance? We're going to be hearing from two colleagues, Konstantinos Chalkias and Ellen Yu, who research and teach on these things. We'll have some time for questions and discussion at the end, and then we'll go into some breakout groups to discuss and hear your insights a little bit further. So to get us started, Konstantinos, do you want to start with a little bit about you? Who are you? What do you teach? What do you do at Birkbeck?
Yeah, of course. Hello, everybody. Good morning, and thanks for joining us. So I'm a senior lecturer in management here at Birkbeck Business School. I am the PhD Management Program Director, and I also teach research philosophy and organizational theory to our PhD students. And I also occasionally deliver workshops as well as short courses on the topic like the one today. I am an active qualitative researcher. I've been doing research on the insurance and reinsurance industry since 2013. It's been 12 years now. And the last 5 years, me and three of my co-investigators, we have been looking into the global issue of unaffordability of house insurance around the world, and we have specifically looking into how governments and markets kind of tend to work in certain ways together to provide insurance and cover for the unaffordability issue in more than 75 countries around the world. So we also written a book on this subject, which is called Disaster Insurance Reimagined, and it's freely, you can access that freely from Oxford University Press as an ebook. So if you're interested in what I'm going to be talking about today, please have a look into the book. You can access it for free.
Amazing, thank you. And Ellen, do you want to introduce yourself? What do you do? What do you research? What do you teach?
Good morning, everyone. I'm Ellen, a senior lecturer in finance from the Birkbeck Business School. So it's my pleasure to contribute to today's breakfast talk organized by Pei-yi. My research interests are environmental finance and the sustainable finance. At the Birkbeck, I teach principal investment management for master student and international financial management for the year 3 student. I have been invited to share my research findings with the U.S. Conference Board and the Federal Stock Exchange. So that's all from me.
Great, thank you. Okay, so starting with Konstantinos, this idea of insurability has really been in the spotlight lately, especially with the recent fires in LA. Could you tell us a little bit more about how this situation of uninsurability arises? How big is the problem? Is it? Who is it impacting the most?
Yeah, absolutely. I mean, I'll start with the recent LA fires, which has caught a lot of press and our attention, but that's essentially a problem that we're facing to a different extent, of course, in most developing and developed countries. So just to give you a sense of what is the problem and why it is important, let's start with California. So we all, not all, but we tend to kind of like buy home insurance when we buy a house. So whoever is actually buying through a mortgage, you have to have home insurance. So it's a prerequisite for a bank or any other financial institution to essentially finance your mortgage. You need to have home insurance. And at the same time, home insurance has been skyrocketing, particularly for those who are considered as high risk. And I'll explain in a minute what is a high risk. But just to give you a sense of why that has been happening, just the recent fires in Los Angeles are expected to be the most expensive such disaster in American history. So the price for insurers, in order to be able to essentially pay the pay the claims for those who have been insured, is calculated at 30 billion. So this, and as you can probably imagine, insurance and reinsurance is a profit-making business, and they're gonna need to recoup this 30 billion. And in order to recoup this 30 billion, what it means is they have to raise premiums. So since 2018 to 2023, so the last 5 years approximately, premiums for home insurance in California have risen by approximately 43%. So half the price up. And on top of that, many companies have identified as home insurance in California as not something that they're interested in, so they have also withdrawn altogether. So many people find their premiums risen by 50%, and many others don't even find insurance to buy it, even if it's going to be more expensive. And the reason behind that is, apart from urbanization and supply chain issues that we all been experiencing and recent inflation reasons, is of course climate change. Just to give you a statistic, which I think is kind of like wide opening in terms of LA, between 2004 and 2013, an average of 653 structures have been destroyed each year by a fire in the state of California. Between 2014 and 2023, that has skyrocketed from 653 to 5,669. So if you have more properties essentially being damaged by fire and any other kind of disaster, that means insurance has also to go up in terms of premiums to kind of like be able to be a financial sustainable business to pay claims after a disaster. And that is something that has been happening all around the world. It has been happening here in the UK in terms of floods. It has been happening in my home country in Greece because of fires and then floods. It has been happening, I guess most of you have seen the last couple of years, devastating floods hitting Central Europe, Poland, Germany, and so on. And more recently, also, I think it was last week, where Australia has been hit by another cyclone, where extreme unaffordability for insurance has risen from, I think it was from 8% last year to 15% this year. So that's basically more or less what is happening and why it's impacting us all.
I mean, it seems like a huge problem. So what do we do about it? How can the insurance industry work with governments and other stakeholders to fund, promote adaptation strategies in these regions which are facing these challenges?
I mean, there are certain things that have been happening around the world, and they're not necessarily new, but quite a lot of them are quite recent. And that's what my research has been looking at, as I said, how governments and markets work together to kind of like address these issues. And what they typically do is they set up some sort of organizations or entities, if you like, what we call in our research protection gap entities, or PGEs, which are essentially insurance or reinsurance vehicles that are of different type of forms based on the political environment on which they're set up. In certain areas, they're quite strongly government owned. In other areas, they're quite privately owned, but with government backing, either financial backing, or even just legislation. And what they essentially do is they try to make insurance affordable and available. And just to give you an example, we have such a vehicle here in the UK, which sits in the background. So so some of you, if you have home insurance in the UK, you might be essentially insured by that vehicle, which is called Floodry, without necessarily knowing it. So what it does, it essentially, for those who are of high risk, of flooding, instead of being essentially insured by the private insurance industry, the private insurance industry passes these high-risk properties into that vehicle, and that vehicle, instead of pricing risk reflectively, which means, as it typically does, which means instead of pricing based on the risk profile, instead of pricing highly the properties which are at high risk, it uses the property valuation, also how much your property is valued at, to essentially give you insurance which is not reflecting the risk, but is reflecting the value of your property, in order to be able to have a society which is highly insured across the UK. As you probably can imagine, that is not necessarily always sustainable, because if the underlying risk essentially remains the same, it means we keep on increasing that pot of people who are highly insured, and that is essentially being recouped by all of us. It's a solidarity model. So that is going to end up becoming not sustainable at a certain point. So what in certain models like that is important, what is happening here in the UK, is government, insurers, and this vehicle are working together to essentially introduce resilience measures. So they're trying to bring the risk down. So they're trying to make homes more insurable by essentially making them less flood prone risk to flood, less prone to flood risk. How do they do that? Is after a certain flat or house or area has been flooded, they put into place resilient measures by making those to make those floods more to withhold floods for next time. Because one of the things that insurance is being built on the premises is like to like. So the same way that your house has been, they're rebuilding it the same way. But that, as you can imagine, holds the problem of building exactly in the same way that it was before. It means it's going to be flooded again in the same way it has flooded before. So it kind of like intervenes into the market and the way that flats and houses are being rebuilt or restored, in order to make them more resilient, in order to be able to withstand the new risks that are being brought to the group by predominantly climate change.
Okay, makes a lot of sense. I'm thinking about the kind of connections between insurance, risk, and investment. Ellen, are there financial products that could encourage the kinds of investments we might like to see in resilient infrastructure to reduce those underlying risks?
Yeah, I would like to share 4 financial instruments uh, which are available for investors. So investor can contribute and encourage moving the investment toward to the resilient infrastructure. So the 4 financial instruments I would like to briefly talk about are climate bonds, green bonds, and green bond funds, and the blended finance. So the first instrument I would like to talk about is climate bonds, so which can be used to finance projects that address the climate change. So they range from wind farms and the solar and hydropower plants to rail transport and the building seawalls in cities threatened by rising sea levels. So what are the difference between climate bonds and the green bonds? So in practice, the green bonds have mostly been the same as the climate bonds. The capital raised by green bonds will also go toward climate change projects. But in theory, the green bonds have a broader definition. The green bond is where the proceeds are allocated to environmental projects. The capital raised by green bonds could be used for different environmental projects, such as park development. So some proceeds have gone to areas seen as environmental, but not necessarily related to climate change. For example, the proceeds may go to organic farm loans as well as to climate change related areas like the sustainable buildings. Then, however, often only institutional investors will invest in green bonds and climate bonds directly. For retail investors, most of us will only invest in green bonds or climate bonds through investing in green bond funds. The reason is, in most cases, the retail investor will not put much personal wealth in bond instruments. For example, Amundi Planet is a green bond fund issued by the biggest French bond company. And the last but not least, blended finance is one financial mechanism I would like to talk about. Blended finance is an essential mechanism because typical investors are risk averse, influenced by past failure, and prefer established asset classes, so which can hinder investment in innovative and sustainable ventures. So blended finance can be used to channel environmental investment towards low-income countries and finance environmental innovation at early stage. What is a blended finance? So blended finance vehicles address specific risks and return associated with green and sustainable technology and infrastructure, and allow the joint effort from commercial banks, capital markets, funds, private sector, and development financial institutions. So what are the development financial institutions? They are government-backed financial institutions. For example, include the World Bank's Climate Investment Funds and the African Development Bank. So the environmental projects sponsored by Blended Finance could range from the production of a green hydrogen or the scaling up private investment in mini grids and the renewable energy generation in isolated overgreen area. So these are the financial instruments uh, I would like to share with everyone.
Thank you, Ellen. It seems like there's a lot of innovative thinking going on around this. Konstantinos, going back to the private disaster insurance market for a second, what do you think the outlook on that is as all of these changes are taking place?
Yeah, I mean, it's. I'm gonna try to make a prediction. Not necessarily a speculative one because it has been something we've been essentially observing for a while now happening, and that's what our book tries also to do a little bit in throughout it and also in the end, and that's why it's called Disaster Insurance Reimagined. Um, in a sense, what we've been seeing around the world is insurance becoming unavoidably more and more unaffordable and more unavailable. As you probably can imagine, that means that the market within which insurance operates is becoming smaller and smaller. And if we continue down that pace that we have been continuing for quite a while, it means that insurance is going to become disaster insurance for home insurance, particularly, is going to become less and less relevant in terms of how we secure our homes from disasters, because less and less people are able to afford it and less areas are having access to it. So something needs to change. And one of the ways that has been changing is through those sort of interventions, government market interventions that we've been seeing around the world. And we have quite a lot of them here in the UK, in Europe, we have in the US, we have in Asia, in Africa, all over the world. And if anything, we haven't been noticing some of them, sunsetting and fading away. It's quite the opposite. We're seeing quite a lot of them cropping up, and also quite a lot of them increasing in scope as well. Instead of like being set up as something. Let's say in Australia, they started as something which was for terrorism. Now it's for cyclone as well. Similarly, in the US, you had something in the US which was for earthquake. Now it's it has becoming also for fires. So the insurance industry and the governments essentially need to work together, both in terms of securing the financial element for homes, but also for resilience. Because climate change is not something which necessarily is reversible. We can essentially slow it down, as we're trying all over the world, without necessarily much success always. But we need to kind of like understand that we're going to be living into a new climate reality, and that reality is affecting also the way that we have access to insurance. And if we want insurance to be accessible and affordable for all, because it's something which quite often holds a social structure together, we need the governments and the markets to work together, both in ways of financing insurance, but also in ways of building and increasing resilience in order to kind of like keep at bay the risk of flooding, the risk of fires, the risk of cyclones, and so on. And a way forward is definitely this sort of vehicles, which, as I said, quite vary also in nature. Quite a lot of them are privately funded, quite a lot of them are government funded, or a mix of both. And we definitely need to start thinking about how to integrate resilience within insurance, because continue going down that road of building and rebuilding houses exactly as they were before a disaster doesn't necessarily mean we build in a resilient way. And if we want to bring down the risk of a house being flooded or catching fire, we need to build houses in a more resilient manner. And in order to do that, we definitely need both the government and the market to be working together in terms of how we rebuild, in terms of where we build, and also in terms of where we not build.
Makes a lot of sense. I mean, it feels like change and uncertainty are kind of themes emerging in this discussion. Ellen, thinking back about investments, how does all of this change, climate change, environmental, other kinds of environmental changes, shape investors' behavior? Is that impacting their behavior?
Yeah, this is a very good question because actually in the finance literature, the researchers have already found the social or religion factor can influence the way how investors think, which then affect their financial decision. Then after the 2016 Paris Climate Agreement and the 2050 net zero goal, then we may say that leadership belief and the value of environmental protection are growing strongly across the country. So, for example, we may hear that environmental campaigns may reduce investor demand for certain type of company, such as oil or coal producing company. Then, according to our research, we have found empirical evidence showing how this climate and environmental change change investor behavior. So we carry out international studying of 1,481 companies across 43 countries. And our results show that investor value and the price a company's transparency in its environmental dimension. So if a company is more transparent in its environmental information, then this company is more likely to enjoy a cheaper cost of equity and a greater market valuation. But this is not a linear relationship. But most of our sample companies' environmental disclosure benefit outweigh their environmental disclosure cost. Then we also find out the shareholder value a company's long-term positive change in its environmental innovation and a better environmental business environment. So, for example, if a company locates a better environmental business environment, investment might perceive the company to be less likely to suffer from environmental scandal, which can result in a uh, low cost of equity. Then in research, we find that the investor value a company's environmental transparency. Then turning into practice, the EU's Corporate Sustainability Reporting Directive, CSRD, officially came into force on 5th January 2023. Then, however, its implementation is phased with different reporting deadlines depending on company size and type. The CSRD is primarily an EU regulation, but it has a global impact. It applies to non-EU companies that have a significant business in Europe. So, for example, multinational corporations like with European business, Apple, Amazon, Toyota, Tesla, must prepare sustainability report that align with the EU sustainability reporting standard. Then, according to the CSRD, this regulation require the company need to report the detailed environmental social governance reporting, and it's mandatory third-party audits for all this data. And company need to disclose climate risk, carbon emissions, social impact, and the governance factor. So all this happen while climate and the environmental change gradually shape investors' behavior and our regulatory environment.
Interesting. I mean, you mentioned transparency is quite important earlier. So I'm wondering how big a problem is greenwashing in this area? And is there anything that could be done around enhancing ESG
Yeah,
disclosures to combat it?
yeah. So like the directive I have just mentioned, the CSRD, the Corporate Sustainability Reporting Directive. The EU also has SFDR. So SFDR is a Sustainable Finance Disclosure Regulation. So SFDR significantly impacts investment funds by by requiring them increasing transparency regarding sustainability consideration in their investment process. So this new regulation at FDR ensure transparency on how investment funds and other financial market participants integrate sustainability risk into their investment decision. So according to the SFDR, all the funds available in the EU will be classified into three categories based on their sustainability focus. So there are Article 6, Article 8, and Article 9. So Article 6 are traditional non-sustainable funds. So they are usually considered ESG risk, but it's not their main investment strategy. So a typical stock or bond fund with no ESG screening. The second one is Article 8, and they are light green funds. So these funds promote environmental and social factors, but they do not have a sustainability as their core objective. So a fund that includes companies with strong ESG ratings, but does not exclude all fossil fuel companies. Then the cleanest one is Article 9, and they are dark green funds. So these funds have a clear sustainable investment objective. They try to reduce carbon emissions and they promote renewable energy. So, for example, a fund that only invests in renewable energy projects or green bonds. So, what does SFDR matter? Because this new regulation will help the investor distinction between different levels of ESG investment, and they can increase transparency and prevent greenwashing. And along with the SFDR, I also want to bring your attention to the another new law, the European Securities and the Markets Authority's fund naming guidelines, which will come into effect for existing fund on 21st May 2025, so 2 months later. This guideline, which already apply for new funds, state the fund which is sustainability-related terms in their names must be meaningfully investing in sustainable assets that have a positive impact and do not harm to the environment or society. The interesting on the news yesterday, the BlackRock is removing sustainability-related terms from the names of their 56 products manage more than 50 billion of assets ahead of the EU incoming naming guidelines. So in an email to clients on 18th March 2025, the BlackRock told their clients it would remove their name, their sustainability related terms, uh, but they say they will keep their investment strategy related to sustainable characteristic. So I want to briefly discuss how a company's greenwashing behavior can be reduced. So in our research related with greenwash, we find out a greater percentage of independent director and institutional ownership can discourage a company's greenwashing behavior, but the both sides does not matter. So at the country level, we find out the absence of corruption and the overall national well-being. For example, a country's human development index And if a listed company is cross-listed outside its home country, can also discourage the greenwashing behavior. So that's all I want to share, how we can discourage the greenwashing behavior.
That seems quite positive. It seems like there's quite a few practices and policies there that can help investors ensure that climate and sustainability related claims are genuine. So yeah, that seems like good progress. Okay, so we've reached the end of our expert discussion time. So I'm going to turn off recording shortly, and then we will hear some questions from the audience and turn over to open discussion. So while I'm turning off the recording, you can get your questions ready for Konstantinos and Ellen.